I'm Caleb Kidd Coy, Epic Legacy Hero Builder, and I'd like to welcome you to Living Like a Bank. Along with myself, you'll hear from other successful experts and people who are busy serving and empowering many lives. You'll see how we're showing others to become debt-free in record time as they build economic discipline while generating a bulletproof family legacy revenue stream together. We'll learn how to live and operate just like the banks do. Today, I'm speaking with David Weiner, founder of Global Renaissance and author of Banking Like a Bank. Let's get right into that conversation. So let's back up and talk about some more history here for a moment because we referenced the Great Depression crash of 1929, which essentially forced the Federal Reserve into existence. Banks had run-ons of their money, meaning depositors came to withdraw their money. They panicked and had a brutal realization the money wasn't there. Why? It had been lent out. Is what's in place today protection enough, Dave, to prevent something like this from happening again in the future if people begin to panic?
The run on a bank is not going to hurt the bank. I know that's a crazy statement. Defaults on mortgages, that could hurt a bank. But even in the worst of times, 15 years ago, it was not a big enough default ratio. Most people know that to stay in their home, they got to make the mortgage payment. Default ratios they thought could have gone past 5 or 10% because consumers started buying gimmicky loans that were backed by Wall Street security. I mean, if you saw the stuff that went on behind the scenes on some of the mortgages that were issued back in the early part of the 2000s, you had a teaser rate mortgage that people thought was the real mortgage rate. You know, they thought they saw rates from, I'm not going to mention any bank names today and really pick on them, but God knows we could. But they had teaser rates at 1%, 1.25%, when the reality was the real interest rate of the mortgage was 8%. But the client was able to have the first 3 years of payments based on a 1 or 1.25%. And this was a problem in this country, the teaser rate mortgage, because traditional mortgages had been extremely profitable for a century. And then all of a sudden, Wall Street convinced the banks to go bottom feeding, which is basically all the rules of qualifying a person for a mortgage were tossed out the window. Now, the best thing that happened to the banking industry after the mortgage meltdown of 2008, Caleb, is that all the rules and regulations came back in for qualification. It became a lot tougher to qualify to borrow money in this country over the last 14, 15 years. And it did not affect the profits of the banks. The banks today are more profitable than anything you can humanly imagine. If our host had the ability to put up an amortization repayment schedule on a mortgage at today's times at 7%, I think our clients that or even the consumers that are participating and listening to what we have to say, I think they would be stunned to how much profitability was in a mortgage in the first 20 years with no gimmicks, no imagination, just a plain Jane mortgage. And when they realized that almost 65 to 75 cents of every dollar paid in a form of a mortgage payment to a bank in the first 20 to 25 years never got applied to their mortgage, I think it would leave the average consumer walking away in disbelief that any regulatory environment would let them be abused to that, to that magnitude. And yet the federal government felt that if the banking system was ever allowed to crash, that we could not function as a society. They've basically have written a rule book that is for the benefit of one institution. Now, guess what? There's a roadmap in what a bank has done. There's a roadmap to anyone's financial prosperity. If you can learn what a bank has done over the last century and just follow the basics of what a bank does, there's not a soul on this planet that could not achieve tremendous financial success and prosperity for them and their loved ones and their families. However, if you do what they tell you to do, you've got no shot at prosperity. If you follow the basic rules of money, and they tell you save, invest, go down to XYZ investment house, open an account, save money in your 401k, your 403b, and all you're doing is saving, and you're still maintaining any kind of form of debt, you've got no shot, because there's too many things stacked up against you, and that's just a reality. But again, back to your question, historically, over the last century, the federal government has done everything in its power to make sure that the banking institutions not fail. In fact, the phrase that was uttered 15 years ago was, they're too big to fail, and we cannot afford them to fail, ever. The entire world stared in disbelief as the Bush administration let Lehman Brothers go bankrupt. And the battle cry was, that should never have been allowed to happen. And it almost took down the entire United States economy when we let just one bank fail.
Mm.
It was a big bank, but when they let that bank fail, it almost took down the entire world. And they'll never let that happen again.
I'd like to thank you for taking the time to be here with us today and answer these questions. I know that people are going to go away with just an ease of mind and hoping essentially that the burden maybe that they've carried is now a realization that that debt can become their greatest future legacy asset. Thanks for tuning into the show. Please be sure you subscribe on YouTube or the podcast on anchor.fm and follow me on social media at Metalpreneur. If you're ready to talk about building your own bank, use the QR code or go to rebrand.ly/buildabank. Be sure and join us for the next broadcast as together we learn to live and operate just like the banks do.